Also joining me on the conversation is Peter Boockvar, the Chief Investment Officer over at Bleakley Financial Group. He's also a CNBC contributor. Also, Mark Zandi, Chief Economist over at Moody's Analytics. So we have a star-studded panel here. Peter, I'll start with you here just because you're sitting right next to me. The comments, the takeaway here is maybe trying to, again, temper the expectations that the market has. The market's already been tempered over the course of the last 3 to 4 weeks, arguably. Has anything really changed with that picture?
Nothing today. I think Powell just reiterated what we've heard from a lot of other Fed members, pretty much what he said at the press conference. I mean, he's juggling some pretty complicated stuff here. It's not just, okay, we raised sharply, we're going to tweak here and there, we'll cut a little bit. I mean, 2-year inflation break-evens are up 50 basis points over the past month. Gasoline prices are at the highest level since early November. Container shipping prices have jumped. So I mention that because goods prices have fallen sharply, but now are at risk at rebounding again, while the service side could continue to moderate with rental prices. Point being that there's a lot of confusing mixed messages here, and I don't think Jay Powell, it's in his interest or even really can push that much ahead in terms of expectations because he doesn't even know. And I think he does not want to start cutting interest rates and watch inflation rise right back up in his face again. And what's being restricted right now? The markets are not being restricted. If you have a commercial real estate loan, then, yeah, you're being restricted. Or if you have credit card debt, yeah, you're being restricted. But this restrictive or not restrictive policy, it depends on who you are.
Now, Mark, the central bankers in America and even Fed Chair Jay Powell today alluded to this, if not spoke directly to this idea, that the strength of the economy right now on a relative basis is what's leading to the ability to be a little bit more patient with regard to the ability to cut interest rates or have to cut interest rates. Does that still play out now, given this transitionary, confusing data that we have?
Well, in my view is the economy is resilient. It's fine. It's okay, but it feels soft to me and in some key places. The job market in particular, you look under the hood. So, for example, today we got data from JOLTS, the Job Opening Labor Turnover Survey. And you can see hiring rates are way down from where they were and across the board, across all industry. Hours worked have fallen sharply, really back to levels you don't see except in recession. Temp help jobs are down. The only thing in the labor market that's kind of keeping it together as well as it's being kept together is layoffs are just extraordinarily low. But I'm not sure we can count on that. So it just feels very fragile to me. And then the financial system and all this discussion around NYCB, that's symptomatic of a broader set of stresses on the system that will remain as long as the yield curve is inverted, which goes right back to, what the Fed's doing. So, it's a balance of risks. It's a matter of judgment. But in my view, the risk is now higher that the Fed's going to keep rates too high, too long, undermine the economy and the financial system. And to what end? I mean, they, in my view, achieved or all but achieved their targets. We're at full employment, a 3.7% unemployment rate. We've been there for 2 years. Inflation's coming in very nicely. You exclude the cost of shelter, and we're back to target and then some. So, why maintain this tight policy in the context of an economy that, is, I think, a bit fragile?
Steve, can you put the risk-reward kind of story on it for us? Because I understand what Mark is saying. I also understand what Peter is saying. But there's a conversation that's being had right now among all of these central planners about where the greater risk lies. Is it the fact that we could send ourselves into a deeper recession, or is it that inflation rears its ugly head in a fairly significant way all over again? What's the balance of scales right now?
Yeah, Dom, you're just like me. You're a reporter. You have two smart guys making good points on this, and you end up in the middle here on this. I think I like Peter's point, which is something I've been talking about for a bit, which is if it ain't broke, how much fiction should the Fed really do to the funds rate right now? I don't know that I see all the fragility that Mark sees. I think we may have had a bout of economic weakness in January that might have been more weather-related and some other issues around it, and might have been one-offs than we had actual gathering weakness in the economy. And I also think that the Fed's litmus test for cutting rates is not that heavy right now. We talked about that just a second ago. The idea they want a bit more evidence and they want to see, I think they're going to cut, but I think they're going to cut relatively modestly, see how things go. I do think the bigger issue here becomes whether or not the Fed can do the monetary policy walk and do the regulatory chewing gum at the same time. By that, I mean, can they work with the banks, and I mean the Treasury and the Federal Reserve both, and other bank regulators, to get them to shore up their balance sheets to make sure this office real estate thing does not become systemic risk, while they take their time and do what just the economic fundamentals suggest they ought to do for interest rates. So I don't know if that's possible, but if they are indeed working, as the chair says, behind the scenes with the banks, then we can maybe take that off the table and say, you know what, there's going to be losses, there's going to be risk, there may be some bank failures here, but that does not become a systemic issue that should drive the train when it comes to monetary policy.